Hello and welcome to the monthly roundup from Kepler Trust Intelligence, brought to you in association with Schroders. Unfortunately, this month Ryan has lost his voice, so we've conscripted Thomas McMahon, our head of investment companies research, to join us to discuss the most interesting news and hot topics for investors from the last month.
Hi Joe, I'll try and do a slightly better job than a man with literally no voice, but I can't promise anything more than that. Also in this month's edition, David looks at how a new government policy impacts Greencoat UK Wind.
Joe looks eastwards for results analysis from Schroder Japan, followed by Thomas taking us through the highlights of Vale's latest results.
But first, we're going to canter through the news, including some sizable share issuance, largely driven by the evolving opportunity of investing in the space economy.
That's right, Joe. We begin with news of a bumper fundraise proposal from Seraphim Space, which offers exposure to the exciting and unique opportunity of the growing space technology sector. Seraphim has been running since July 2021. It had a challenging period in 22 and 23, where admittedly most of the investment trust sector did suffer, but it's come back very strongly in the period since, especially in the past 6 months or so. Investors will be sitting on some handsome gains if they were brave when it was on a very wide discount. The space asset class has really come to the forefront, with part of that being to do with, of course, SpaceX.
Which we're going to come back to later.
Absolutely. And perhaps also helped by the success of the Artemis 2 mission.
Yeah, so that's a nice background on the trust, but what about this fundraise in particular?
Well, with the trust having rocketed in the past
year,
it's announced plans to raise C shares of up to £350 million, which will roughly double the size of the trust, all things equal. Now, in our recent webinar with CIO James Brugger, he claimed that the space tech opportunity was bigger than AI, which could therefore provide a sizable pipeline of opportunities in new firms, and also the money will help them to top up existing opportunities. SSIT targets private companies for the most part, so a number of its holdings will require follow-on funding. Although one of the drivers behind the excellent performance of the past year or so is the prospect of these firms moving towards a public listing.
And on a slightly tangential news story, we note that Scottish Mortgage has begun issuing shares again as well.
It sure has, which is a very interesting dynamic. The trust was previously a bit of a poster child for our sector, especially after its amazing success in the pandemic period, one of the highlights of 2020, where there weren't very many. But it also suffered from a sizable drawdown in 2022 when interest rates rose. It's traded at a discount since, but that has narrowed to the point that the trust is now trading on a first sustained premium since 2021. And so we've seen some share issuance in April.
And what's been the main driver of this, do you think?
Well, I think, as you alluded to earlier, much of this is simply to do with thanks to Elon Musk. SpaceX, currently private, but heavily rumoured to be progressing towards an IPO later this year with some incredible valuations, if you believe the press. The valuation of the firm has been written up multiple times as milestones have been met, and perhaps after some creative shuffling of assets between Elon's other investments. And this has been positive for Scottish Mortgage's NAV, as it's now the largest position in the portfolio at around a fifth of the NAV as of the end of March.
Which I imagine has had a big impact on performance.
It has, with the position having been held since 2018, and it's grown from a couple of $100 million at first to several billion as SpaceX has delivered on promises. This has really helped returns and, of course, could do even more if it achieves the rumoured 1.5 trillion valuation, although who knows whether that's real or simply a number that Elon Musk has raised to create some excitement. But this optimism has certainly been feeding through to the rating of Scottish Mortgage, allowing one of the industry's largest and most well-known trusts to issue shares, which has got to be good news for the sector as a whole.
So staying on the topic of large and well-known trusts, we now turn our attention to Greencoat UK Wind, which has seen another government policy-led announcement. So David, what's been happening there?
Yeah, there has been a few policy changes within the renewable energy space so far this year that have the kind of potential to impact Greencoat UK Wind as well as others in the sector, of course. And the most recent piece of news is that the government will put forward legislation to remove carbon price support from April 2028. Now, the CPS is a tax on fossil fuels used within electricity generation.
Okay, so what do we think this means for UK wind?
Well, UKW has said that it always anticipated that the CPS rates would reduce significantly, and that this has been built into the forecasts in Schroder's Greencoat's valuation assumptions. Now, the recent announcement does bring that forward, and an analysis carried out by Schroder's Greencoat has indicated that electricity prices used in UKW's NAV could fall by approximately £4 to £5 per megawatt hour from April 2028 to the early 2030s, and by £2 to £3 per megawatt hour thereafter. So ultimately, a preliminary assessment suggests that it could reduce UKW's NAV by 3 to 5 pence per share.
Now, it wouldn't be a news section without a comment on Saba Capital's latest doings. So, Joe, can you give us a quick rundown on what they've been up to?
Yep, I'd absolutely love to. So first, there's the situation at Impax Environmental Markets. Nearly 80% of shareholders elected to tender. That's greatly reduced the size of the trust and also enabled many investors to get out of a potentially Saba-controlled vehicle. However, Saba was one of those that reduced its own share count too. It does remain a sizable holder. It's therefore presumably hoping to use this position to oust the existing board and install its own nominees. So effectively, this does mean that the trust future is even more uncertain. One likely outcome, though, is that the remaining pool of assets is co-opted in some sense along Saba's recently launched ETF to further target discounted investment trusts.
So this sounds quite similar to the Edinburgh Worldwide situation, is that right?
Yeah, pretty much, yes, albeit through a slightly different journey. Saba did manage to win the vote against a large tender offer here, only to then vote against their own tender proposals, hope you're keeping up, to keep the assets within the trust and place their own board nominees in place. This is likely, we think, to see a mandate adopted allowing them to target other UK trusts that are on a discount. Ultimately, this does mean that despite facing multiple rejections, Saba has managed to finally get its way and now has a much larger asset pool under its control to use to go after others in the industry.
Well, let's move on from that with a look at some results. Thomas, you covered the results of Vietnam Enterprises, or VAIL. What do their results reveal?
Well, it was a good full year set of results for VAIL, covering the 2025 financial year ending in December. There was NAV total return was 25% in USD or 16% in GBP. Most notably, this is significantly better than the other two Vietnamese trusts, both of which were actually down in GBP terms. So share price returns were a little bit higher too, 30% in GBP terms. The discount narrowed over the year. It's true, though, that VAIL's NAV was slightly behind the benchmark VN index, primarily due to the 700% return from one company, which is the largest company in the index, Vin Group. So a tough market to beat, but really good results from VAIL.
And what's our view on the opportunity more generally?
Well, I think the trust offers exposure to a pretty compelling growth story. The key growth drivers are domestic, which is particularly attractive given everything that's going on in the world. You have very strong reform program from government. There's recently been a refreshment of people at the top, and they're all very focused on a number of new bits of legislation that have gone through to increase the size of the private sector, but also a massive infrastructure spending plan. And infrastructure is always good for investors one way or another, and the portfolio is positioned accordingly. On the economy, the GDP grew at a record 8% annualized in Q1. The market trades at around 11 times forward earnings. And then we have the upgrade by FTSE to emerging market status in September, which the Dragon Capital team, the managers of VAIL, estimate could bring something like $6 to $8 billion of inflows over the next year or so. There's also a solid pipeline of IPOs over the next few years. This is quite a new equity market with a lot of government controlled or influenced conglomerates that are slowly hiving bits of themselves off and creating new companies. So this should encourage foreign investors in, we think, and create a better diversified market. You still have a pretty decent discount as well, although it's come in over the last 6 months or so. Maybe this could prove a decent entry point in hindsight.
And sticking with Asia, Joe, you've had a look at the results for Schroder Japan. Could you just talk us through a few of the highlights?
Yeah, so these were half-year results to January 2026, a strong set of numbers. NAV return of just under 19%, share price return of 27%, and both were well ahead of the topics, which returned about 15%. And two things in particular kind of drove that outperformance. First was some well-chosen AI-related holdings, with JX Advanced Metals in particular. That's for play on high-end semiconductor materials rather than the more obvious AI names. And secondly, the domestic inflation story in Japan is really starting to feed through into earnings. And they saw holdings like Infoneer and Sankey Engineering benefiting from that improved pricing power. Also, just worth noting that discount had narrowed to about 7% at this point. The board has been active on buybacks. They've repurchased about 1% of shares over the period.
What about our broader view on the trust?
Yeah, I think this is where it gets interesting because the discount has actually widened back out to nearly 12% since the period end. And we think this does look a little bit overdone given the quality of the portfolio there. Now, the manager, Masaki's got a pretty differentiated approach. He's not chasing the crowded AI trades. He's looking further down the value chain for second order beneficiaries at more attractive valuations. And we think that's a sensible way to access those structural themes without paying a premium. If you add on top of that, it's got the highest dividend yield in the AIC Japan sector at just over 3%. You've got some positive fee changes coming in August. There's also some ongoing tailwinds from Japanese corporate governance reform. We think you've got a fairly compelling investment case there. Though in fairness, a smaller company exposure could see some short-term fluctuations given the global backdrop at the moment.
And moving away from Asia, but keeping with results and emerging markets, Thomas, you've been looking at BlackRock Latin America. What's happened of note with them?
Yeah, an excellent set of results for BlackRock Latin America, which delivered NAV returns of 44% in GBP over 2025. This is predominantly driven by, of course, strong commodity prices. Copper and gold did particularly well, and that boosted countries like Peru and Chile. And a weaker US dollar also supported the region. But as ever, it's the strength of the Brazilian market, which makes up over 60% of the index, that's really helped that trust do well.
And was there any trust-specific news announced?
Yes, there was. Despite the returns being excellent in absolute terms, they were slightly behind the performance of the index. And so the board has proposed a 25% tender due later this month, and also a 100% tender in 4 years' time should the trust underperform over those years.
That's some interesting corporate activity. So what's their take on this?
Yeah, it's pretty punchy. The 100% tender effectively gives you a free hit of a sort, in terms of the discount at least, investing in Latin America, which obviously has very high return potential. The region makes up a tiny portion of global markets, but a much higher proportion of global GDP, and offers considerable diversification to a broader portfolio. I think it's often overlooked, but due to its geographical location and the political situation in its main countries, it's managed to maintain good relations with both the US and China. And so it's not too poorly positioned in the light of the current trade war. Plus, of course, there's the high commodity exposure, and that is being supported by the build-out of the AI trade too. So there's a lot to like, and I think that the tender offer really adds a nice, some downside protection.
And that brings us to the end of results, so we'll move on to podcast next. David, you talked all things fixed income with Liontrust, Charmin, Raman. So what topics came up there?
Yes, we covered quite a bit of ground, most notably on the high yield market and why investors might consider an allocation to it, since Charmin does co-manage a high yield bond fund. One point that Charmin made that I thought was interesting was that there's much less junk within the high yield asset class at the moment than there used to be. You can now kind of get much better diversification than in previous cycles, with high yield issuers now kind of spanning many more different industries and sectors. And in addition, around 2/3 of the index is BB rated, which is much higher than it was in the past. So that kind of suggests there's a better quality pool for fund managers to be fishing in.
And what were her views on the markets in general?
Yeah, so Charmin spoke about the so-called SaaSpocalypse, which is affecting both equity and bond markets at the moment. Now, her view is that the initial sell-off that we saw within the software space more represented investor sentiment, that AI is just going to disrupt software companies wholesale, rather than focusing on fundamentals. But now investors do seem to have come to the realization that there will be divergence within the sector. Some companies are inevitably going to see their business models disrupted, but others will actually probably thrive. And many look strong from a balance sheet perspective. So I think that's kind of what she's thinking about in terms of that side of things.
Now, David, it's your turn for Stat of the Month. So what little nugget did you want to share with us there?
Yes, I came across what I thought was quite an interesting stat while researching an article that I was writing on private equity, on just how high we've seen valuations in some areas of the unlisted company space soar in recent years. Now, the data point that I saw was that the Morningstar PitchBook Unicorn 20 index rose 107.3% in 2025, which kind of saw it absolutely thrash the return from public markets. To compare, the Morningstar US market index returned only 17.4% in US dollar terms.
Very interesting, but I have to admit that's the first time I've heard of this index. David, could you tell us a bit more which companies are included in this index and what does it mean?
Yeah, so basically the index tracks, unsurprisingly, the 20 largest and most liquid unicorns. Now, a quick reminder that a unicorn is a privately owned company worth more than $1 billion. Now, clearly that tag is extremely out of date, since the companies included in that index, like SpaceX, OpenAI, Anthropic, and Stripe, are now worth hundreds of billions of dollars. But not only did the unicorns double last year, they also saw their valuations rise by about 60% in the previous year, in 2024. So that's around a 230% return in the space of just 24 months. Now, clearly there are some real, interesting and transformative areas that are pushing these valuations up. You think of those companies I mentioned: space technology, artificial intelligence, quantum computing, etc. It's pretty mind-boggling stuff, really.
And those mind-boggling returns bring us nicely full circle back to the topic of space. So we've been writing a bit about the upcoming SpaceX IPO, and it isn't actually a big holding of Seraphim Space, but I've taken the plunge, bought Seraphim in early March, and I'm currently sitting on a, forgive the pun, meteoric 50% odd gain. Now, I have a feeling that you're both about to tell me why it's going to plummet back to Earth shortly.
Yeah, I've looked at Seraphim. I looked at it when it was on, what was it, like 60 odd % discount or something ridiculous, and now it's on some 50 odd % premium. So definitely with that one, I'm steering clear. I also kind of feel like I have a kind of reservations about investing in space. Like we've not done the best job at keeping Earth running well. I'm not sure we want to go about ruining Mars or the moon or wherever they're trying to jet off to. But yeah, I was also, looking at those returns you're seeing in the private company space, and you're thinking about people kind of talking about whether the stock market's in a bubble, and I'm just wondering whether actually it's the kind of unlisted, the kind of large cap part of the unlisted universe that's kind of in a bit of a bubble. I do invest in Scottish Mortgage, which obviously has SpaceX and a few of those other companies there. So it's definitely something I'm monitoring, and we'll see how SpaceX does when it flows later on in the year, to see if we are really in a bubble or anything.
Thomas, care to add anything?
Well, all I would say is that congratulations on
Thank you,
on
Thomas.
your gains, but premium is telling you something. It's telling you that the market thinks the value of the assets are more than what's recognised in the share price. That has to be proven at some point, and it may well be proven. But it's worth remembering that the gains that you made to get here are unlikely to be repeated to the same degree. This is a matter of something moving from a very wide discount onto a premium because of some specific moves and deals with its largest holding, largely. So I think, really exciting place, and definitely is one to consider. But as ever, I would be diversified, and I would lean towards looking at adding to things that are currently on a discount rather than to this.
As you say, much to ponder there. And on that note, thanks for joining us for the monthly Roundup, brought to you in association with Schroders. For more investment trust news, insights and updates, head over to Kepler Trust Intelligence, and we hope to see you again next month. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.